Hello, and thank you for joining me for our fourth quarter investment update. I'm Angela Palacios, Director of Investments here at the Center, and later you will hear from Nick Boguth, Senior Portfolio Manager. 2023 certainly was a year for the record books. The S&P 500 was up sharply for the year, but notably in the last quarter, we started to see strong performance from other areas of the market like international investments and small company stocks. Expect the unexpected would have been a good mantra leading into 2023. The US economy avoided a recession in contrast to what many had forecasted. The equity markets in 2022 were certainly signaling a recession as they entered correction territory in October. Fast forward to today, and investors may be feeling fatigued from what has been a volatile and unpredictable year. There were some crazy moments, causing markets to retreat when we saw several technology-focused banks literally close their doors until they were backed by the government. In spite of that, artificial intelligence hype took over, driving the Magnificent Seven, as they're now called, up sharply. These included companies like NVIDIA, Apple, Alphabet, known widely as Google, Microsoft, Amazon, Meta, or Facebook, and Tesla. Much of the recovery was enabled by inflation coming under control throughout 2023. So why wasn't there a recession? Take a look at these charts. They seem to indicate that in major portions of the economy, we had some contractions. They just didn't happen at the same time. This is unusual. Take, for example, the top right chart. Manufacturing is currently in contraction. Usually when this reading is below 50, this is consistent with recessionary times. However, many of the other industries are currently digging out of earlier recessionary readings like housing, semiconductors, and travel. Typically, an inverted yield curve is a great indicator of a coming recession, and we've experienced an inverted yield curve for well over a year now. However, what is different this time is we're fighting inflation like we haven't experienced in our country since the 1980s. Now that inflation is back under control, the Federal Reserve should be free to start cutting rates slowly next year. Speaking of inflation, this is a chart that I've shared before, and I think it's an interesting one to bring up again. First, you can see that the pace of inflation has pulled way back, with a total inflation peaking over 9% about a year and a half ago and coming down to the low 3% range again. This is more in line with long-term averages. Most of the inflation reduction came from new and used vehicle pricing cooling off. That's the red area of the graph. Energy prices coming down, which is the green bar. We are feeling this relief at the gas pump in particular. Food prices are leveling off as well, so we are seeing much less contribution from the purple area. But there are still sticky areas of inflation, including services, which is the light blue portion of the bar, and shelter pricing, which is the darker blue area of the bar. Higher interest rates are starting to impact these areas, and progress downward is slow but steady. Mortgage interest rates increasing is part of the reason shelter price growth is leveling off. Interest rates on new mortgages peaked in October of 2023 and have slowly started to move down as interest rates overall started to move down. As rates come down, houses become more affordable for buyers that can't pay all cash.
Thank you for all of that insight, Angie. I am Nick Boguth, Senior Portfolio Manager at the Center. And given all of this, when looking forward, many investors are asking a natural question: what's going to happen in 2024? Surprises, headlines, unexpected events, market volatility. These may not be the answers we want to hear, but they are the answers we can say with certainty. Predicting the future, as last year and every other year has shown, is a losing battle. But thinking about potential outcomes and having a plan in place if those outcomes play out is integral to our investment philosophy. There are more details in the written commentary, but some key themes that we are keeping our eye on for the next year include changes in inflation expectations, interest rates, elections, asset valuations, currency strength, and news cycles. Any one of these themes could trigger market events that our investment committee would review for portfolio changes. But ultimately, our philosophy will remain the same. We will stay invested in diversified portfolios, use market volatility as an opportunity to rebalance, and monitor market changes within our investment committee to decide whether the market is providing an opportunity for the long-term investor to take advantage of. Thanks for joining. Have a happy new year, and please let us know if you have any questions.